Hello and good morning, everyone. Welcome back to Almus Market Mornings, your daily dose of global financial updates with me, Swaraj. It is widely expected that the US Fed will raise rates and that too to a 22-year high. While markets don't move much when what's expected is done, what markets would be keenly looking at is the forward guidance. The current expectation is, of course, of a hike in this current meeting and then a pause. But any statement that changes this perception will lead to a movement in the markets. Good morning, JK. Keeping in mind the recent data which has come out, what do you think the Fed will say about the next meeting? Is it possible that they might have a dovish surprise?
I'm not very sure because US data has not really confirmed the recessionary expectations of the analysts and the markets so far. We have had mixed data, but broadly we haven't seen major crash in any of the numbers, and we're still holding up. On key numbers, inflation has come down, and there is an good number of analysts who actually expect a soft landing for the US economy. However, I think the Fed is unlikely to get too complacent on the inflation until they see more consistent fall, and hence I would expect them to be non-committal about future rate increases and possibly say a data dependent approach once again, and that will be neutral for the market, and that won't be a shock for the market. I think most people think that that would be the way they would come. But for me, I'm looking more at the meeting to follow the Fed by the ECB, because there has been a contrasting economic performance by US and Europe, which has continued. Like yesterday, we had the Conference Board's Consumer Confidence Index data from the US in July, which jumped to 117 from 110.1 in June, reaching the highest level since 2021. And the Germany business climate, on the other hand, fell for the third month in a row, coming at 88.6 from 87.3 in July. Now, the IFO survey also aligned with the German private sector PMI survey, which revealed a negative outlook on activity for the first time in December. Now, according to July 23 area bank lending survey as well, banks have seen further, tightening of credit, and the demand for firms for loan drawing of credit lines has fallen to its all-time low since the survey began in 2023, and the demand for loans actually decreased to minus 42% of that minus 38% in the previous quarter. So this is again another indication how the economic activity has been dropping. Now, further evidence, IMF forecast published overnight show a small lift to 2023 global growth forecast from 2.8 in April to 3% in July, but contained a downward revision for Germany, the only G7 country now to be seen contracting over the whole of 2023. So in this context, and also in PMI survey also, we had seen the price pressures have been decreasing in the euro area. Therefore, I would more bet on Lagarde getting a bit dovish, giving more importance to growth than Powell doing that. So this is actually a good sign for the investors, because if eurozone interest rates are also going to peak around the expected level of 3.75%, or at least go for a pause, and that would be a great boost to the economic sentiment and as well as the market sentiment. So that's what I would look at. Of course, BOJ on Friday is still a toss-up, and I don't want to speculate because market expectations are highly diversified. Logically, they should be tweaking the policy, but you never know with the Bank of Japan until they actually announce. On the markets, of course, we had the yields in US again moving in contrast to Europe and going higher. And this is not only boosted by the good economic number, but also by the fact that the continued heavy supply of paper from the Treasury, and it is expected to continue in the coming months as well. Therefore, the yields are not seeing, people have already been buying, looking at the attractive levels, but after the yields keep going up, the buying has actually been tapering off. So the US yields are still on the upswing, and therefore I would expect the dollar to be very well supported because of that. And as per the FOMC meeting itself, I think there will be no economic projections at this meeting, but there will be some guidance from Powell, saying how the data dependency will be continuing to guide them in their actions. On the stock market, Dow took a pass, but Nasdaq took over, well supported by good numbers from Google and Microsoft, both exceeding the Wall Street expectations. In fact, strongest indication from China Politburo yesterday, particularly to the private sector, pledging to address both supply side and demand side factors, spurred a risk-on sentiment in the global indices, which went up nearly 0.5%. And China yuan, in fact, responded positively to the consistent and persistent efforts by the Chinese central bank, both on the currency market as well as on the economy, which has actually boosted the currency. Now, this also has seen the European market recover by nearly 0.5%. Oil prices rose to 3-month highs on both tighter supplies and also by fresh prospects or fresh optimism about China. So, as for the dollar index is concerned, it has continued to be well supported, mainly because of the weakness in the euro and also to some extent in the yen. Chinese yuan, of course, fell to fresh support to 7.13 after trading well above 7.20 for several days. And that, of course, today, once again, we have had some setback to one of the property corporations, which whose share prices have fallen nearly 20%. But overall, market retains some optimism on China, and optimism on China is actually boosting the overall global sentiment. I expect markets to be somewhat subdued today ahead of the three major G3 rate decisions that would be on the radar. Of course, not only the rate decisions, but also we have the US GDP number, US core PCE number, and importantly, even the German flash CPI numbers for the month of July, which will be published on Friday. So a lot of numbers to digest before we take a direction for the dollar. My bias is for some more strength in the dollar based on higher yields and also relative better performance of the US economy. USD INR, yes, the well-touted support at 81.70 held. PSU banks came promptly at the support level and pushed it up to 81.89. On the way up, once 81.70 was broken through, we saw more importers jumping in. The continued or the successive attempts to break 81.70 having failed has convinced more importers to increase their hedges at these levels, and also the oil prices, which have jumped nearly 20% from the low of the year, is again one negative for the rupee, which should be keeping the USD INR pair well supported. Technically, a move back to 82.10.20 is on the cards. Of course, we keep an eye on the flows, because eventually the flows will be determining whether INR also catches up with some performance on again, like other currencies. Overall, expect a slightly less active day until we get the decisions and looking ahead to the data on the coming sessions. Thank you.
Thank you, JK. And one major theme which I caught on was, of course, the contrasting economic performance by US and Europe, especially the largest economy in Europe, which is Germany. German business confidence and PMI figures both are not quite inspiring when it comes to an optimistic outlook for the German economy. So there is more of a bet on EU's dovish tilt compared to Fed's dovish tilt. Maybe a battle of who outdoes the Fed has already started. We of course saw oil prices rising, backed by fresh optimism on China and tighter supply, while on the rupee front, 81.70 was an important support which held on, and we saw some buying from PSU banks. That's it from us today. Tune in tomorrow where we discuss the FOMC outcome. And JK will be covering that in detail. So do make sure to join us tomorrow. That's it from us today. Thank you so much for listening.